You're listening to Kat Feeney on ABC Radio Brisbane and Queensland.
10 minutes past 1. Last week you would have heard the RBA announcing its 8th consecutive interest rate rise, bringing the cash rate to 3.1%. Now, has this put pressure on your mortgage? Have you got a fixed rate that's about to expire? You're wondering by how much your payments or repayments will increase? Well, what can you do if you are starting to feel a little concerned? Maybe not about your mortgage, maybe someone else in the family with a mortgage set to go up by a fair whack. Well, Phil McGann has some ideas for you. He's the Director of Claritude Financial Planning here in Brisbane. Phil, what was your reaction when you heard about the RBA's decision to raise the cash rate?
Raise the cash rate. Look, it was a long time coming. We all saw it. It's eight months in a row now that we've risen it up. The interesting thing about this topic we're going through today, Kat, is obviously what the topic about is all the fixed rates coming out over the next 12 months. Mm-hmm. The history behind it obviously is during COVID, interest rates were cut to barely anything. The Reserve Bank Governor came out potentially erroneously and sort of said we're not going to see rate rises till 2024. A lot of people rushed into the market and borrowed potentially a lot more money at low rates than they thought they should have or could have. And next year, they're coming, I suppose the chickens are coming home to roost a little bit over the next 12 months. There's a lot of money coming off fixed rates over the next 12 months. So figures I saw yesterday were anything up to about $300 billion over the next 12 months. So about $40 billion a month-ish coming off. People are coming from fixed rates of potentially under 2%. Some people actually were very lucky to grab a rate of about 1.18, 1.89, and now they're coming up to about 4.5%, 4.8%, 5%.
I mean, that is a big jump.
It's a big jump.
But a bank wouldn't have given you a rate like that if you couldn't afford it, Phil, right?
No, well, at the time, what they do, there's credit rules in place. If the interest rate at the time is X, they're allowed to lend you money up to a multiple of that, or usually they tack on about 2.5% to 3%. So it was within the guidelines, but interest rates have galloped ahead so quickly this year that a lot of people are starting to feel the pinch. So that's the history behind it, and where people are at is that they are potentially seeing interest rates coming off over the next 12 months, going from 2% to maybe 5%.
Yeah, okay. So look, just at this point, a reminder that our conversation is general in nature. So if you're worried about your financial position, you really should seek personalised, individual, professional financial advice. Phil McGann is with Claritude Financial Planner, and we are talking in general terms about some of the things you might want to consider.
Correct.
So if you're in that position, or maybe someone in your family,
if you know about it, Christmas is coming up. It's a good opportunity to meet up and talk to them and say, listen,
what do you do?
Where are you at? Look, if you know that your interest rate is coming off its fixed term in March or May or September, what you want to do is actually find out now what it is likely to be reverting to on a variable basis. Talk to your bank or look at your bank website to see where it is, and then try to calculate out. There's lots of calculators, or ring the bank up and find out what will your repayment be in March or May or September next year. And then what you could do is you could term it a Clayton's loan. You could actually start paying your mortgage back as if you were on that higher rate.
Now, why would you want to do that?
Because all of a sudden, instead of going from $1,400 a month to $2,800 a month, it's a big shift. It's a big
shock.
Big shock.
And in a new year, and back to school or whatever all the other bills are.
So if you could sort of start seeing now how it fits into your budget, and don't put the money into the mortgage, but put it into a separate bank account, and it gives you that buffer on the way to where it. If you can see that this is going to be a real big problem for you come middle of next year because you have all these extra bills on board, that's when you need to sort of start deciding what you want to do with other expenses in your budget, or talk with your bank to sort of say, this is going to be a real struggle for me. What options are available for me? You may well negotiate something better with your bank, a better rate, but you can also look to do other things with other banks. There's a lot of good incentives out there at the present time. It's a very, very competitive banking environment at the present time. And some of the incentives I've seen, $2,000 to $3,000 to $5,000 to refinance your home loan somewhere else. Now, is that for everyone? No, but it may well be possible for some people to have a look at that and see. But it's being preempting things. There's no point leaving it head in the sand till June and then all of a sudden
freaking out.
And it goes up by $1,000. Can you afford an extra $1,000 a month on your mortgage? probably not. You need to start curbing things a little bit on this side.
1:15, ABC Radio Brisbane and Gold Coast. Phil McGann from Claritude Financial Planning with you, talking very generally about mortgages, what you might want to do if yours is about to go up, if your repayments are about to get significantly larger, maybe because you were coming off a fixed rate mortgage. So fixed, variable, what are you thinking this time around?
Well, the interesting thing is this. You don't fix your rate in to try and preempt where interest rates are going to be in the future. That's a bit of a mug's game because it's so difficult to get exactly right. You're talking over a 30-year loan. But what you're really trying to do, if you fix your rate in, it's all to do with your personal circumstances. If you need certainty over the next 5 years, this is what my income will be, this is what I need my mortgage to be at, you would fix your rate in. At the present time, though, if you looked at the fixed rates, that's very much higher than the variable rates. At the present time, variable rates average is about 4.8. The average 3-year fixed rate's about 5.8. So would you rush out and lock in an extra 1% higher just to give yourself some certainty? It's an individual circumstance, but you need to talk to your broker, talk to your bank. But that's why a lot of the fixed rates, they're not very popular at the moment. It's only about 4% of loans at the moment are being fixed again. Because those rates are so high. We've probably got another couple of rate rises to come. We'll wait and see. That will happen probably February, March, April. But beyond that, it's a little bit too far into the future to see with any clarity, I suppose you'd say.
Okay. What other things could you consider, other advice for managing a mortgage?
Well, you've really got to come back to the budget. You've got to see what you're spending your money on. Look, the interesting thing is, yes, people borrowed money at very cheap rates or they refinanced at very cheap rates. That had a really big interest saving over the last 3 years. Where is all that money gone? Have you improved your lifestyle, the standard of your lifestyle? Have you been buying things that you probably wouldn't have 3 years ago if your interest rates was at normal levels? Because we weren't at normal levels for 2 or 3 years and now we are. So maybe it's a time to New Year's resolutions, have a look at your budget saying, well, are we living beyond our means? What's more important to us? You have to pay your mortgage, you have to live somewhere, but do you really need those extra things that you're spending your discretionary money on? Is it time to curb those and bring those back into the fold to help you service your essential debt, which is your mortgage?
Yeah. I know my bank started itemising my sort of weekly spend. It's quite a revealing study of what I choose to spend on. Maybe a lot of it isn't necessary spending, and that's
potentially.
The point.
And
that's
look, and everyone's individual circumstance, but you choose what you want to spend your money on. You have to spend money on certain things, and your mortgage is probably the most important thing you have to spend money on. Everything else is discretionary to a point. So it's a case of an opportunity. New year, resolution, work it through.
There we go. All right. Well, Phil McGann, thank you very much for setting us up for some healthy conversations around the tables indeed. This festive season. We look forward to more in the new year. Thank you for your time.
Thank you very much.
This afternoon and this year. Phil McGann with you from Claritude Financial Planning. He's the director of that organisation. And just a reminder that our chat has been general in nature. So please do, if you are needing financial advice, reach out to the appropriate professional in person.